Do you want to know what your options are in a difficult time like an economic recession? Do you want to know about the methods that can save you more money? If your answer is yes, then stay right here with us on BBiz, as we're about to disclose some of the effective strategies that most business experts and investors go for. Experts have never stopped talking about an economic recession in 2023, and projections indicate that consumer prices will remain high in the upcoming months of this year. Even worse, poverty may grow, and investors are still grieving from equities and bond indicators dropping by double digits last year. Now, the economists think that the chances of a recession in the next 12 months are at 61%, according to a source. As a result, experts advise taking cautious steps with your hard-earned money. With that being said, one thing's for sure. We can look both to history and to today's record-high pricing situation and to see the same result. The Federal Reserve's rapid contraction is a major contributor to a probable economic downturn. Recessions have historically occurred when the Fed raised interest rates to fight excessive inflation. Although there are other crisis signs to keep in mind in the grander scheme of things, such as increasing joblessness, there is no doubt that recession worries are leaving many Americans concerned about their economic prospects. That's not too surprising, according to a survey done by CNBC All-America Workforce, which indicated that 83% of people with jobs are concerned about an economic downturn, making it the most pressing immediate concern, even more than concerns about wages, which were at 74%, COVID at 62%, pay cuts at 46%, and layoffs at 44%. We won't know for sure if we're in a recession until the data becomes available in July, as a recession is strictly defined as a pair of quarters of decreasing gross domestic product, or GDP. Yet economic flows like these are unavoidable. Meanwhile, experts say that it's never a bad idea to do a check-in with your spending habits in order to put yourself in the best financial situation you can. You can relax about what unfolds in the economy in the future if right now you've laid the most solid foundation possible. So, what are the best possible ways to save yourself from an economic downturn? Well, the answer is very clear. You can, without a doubt, take advantage of an economic recession by holding on to some of today's strategies, all suggested by different business experts and investors. Let's have a look at these fundamental rules and methods that you can look up to while going through a difficult economic period. While market changes can be both exhilarating and disturbing, it's important to keep in mind that investing is an extended game, in which you benefit the most by persevering through both the ups and the downs. In fact, a market slump is a great moment to buy equities at a discount. Experts advocate a dollar-cost averaging plan for those who want to profit while avoiding risk. This method comprises of investing little amounts at regular times rather than a large lump payment all at once. This lessens the impact of instability on an investment. It is also advised that investors accept government incentives in the form of losses. In other words, investors who decide to sell a losing investment can subsequently employ the loss to make up for their tax capital gains, which also means that, as an investor, you need to be patient with the company you're investing in if you're to get the most out of it. Pretty interesting, right? Another way to make up in a crucial economic situation, as suggested by the business experts, is to have more dividends. If you're going to invest in equities during a downturn, opt for developed, big-cap businesses with robust financial statements and cash flows. These corporations are not only better positioned to withstand recessions than smaller companies with inadequate cash flows, but they are also more inclined to give out dividends. So how do the dividends perform in a time of crisis? And how are they beneficial? Dividends serve several functions for investors. For starters, if a firm has a lengthy history of paying and rising dividends, you may be confident that it is economically viable and can withstand most economic conditions. Second, dividends serve as a return buffer. Even if stock prices fall, you will still receive an income on the money you invested. Dividend equities beat non-dividend stocks during bear markets for these reasons. Mutual investments or exchange-traded funds that invest solely in dividend-paying firms are the best method to hold dividend stocks. Funds that invest in firms that have a long history of paying dividends and a great track record of increasing those payments typically produce high current returns, as well as appreciation in value when the stock rises. During market recoveries, funds that only invest in dividend-paying firms may underperform the market. This is because these funds invest in companies that deliver consistent returns across market cycles. As a result, if the market recovers, you can progressively withdraw from your dividend accounts, but you should always save a part as a safety net. There is a famous proverb that necessities never end. Even in the most difficult of times, our needs always stay with us. and that's where we can take full advantage. Even during economic downturns, people have to buy food, medication, hygiene goods, and healthcare products. These are consumer essentials, and they are the last of the goods sacrificed from the household budget. Firms selling high-end gadgets and other luxury goods see revenue declines during economic downturns, but firms selling food and other needs do not. As a result, companies in the consumer staples category are commonly referred to as defensive stocks, as they tend to be durable even when the economy comes up short. Data reveals that these businesses have beat the S&P 500 over the last 5 recessions. Johnson & Johnson, Procter & Gamble, Conagra, and Walmart are examples of consumer staple firms. These companies often pay high dividends, which adds to their protective profile. There are also invested funds that invest in consumer staples. The Fidelity Select Consumer Necessities portfolio, for example, invests at least 80% of its holdings in companies that manufacture, sell, or distribute consumer necessities. So, by doing the same as these smart investors, you can definitely achieve the mark by investing in something that is the need of the customers, and allow yourself plenty of resources to fight through the tough economic situation. Apart from investing in dividends and defensive consumer essential stocks, you can also combat a high inflation situation by making sure that you are making your money go further. As the cost of living rises, customers are forced to determine how to make the most of their limited resources. Efficiency is key. For an example, some economic specialists address rising fuel costs directly. With the national mean nearing $5 a gallon at the time they were quoting, economic specialists recommend people to take public transport, carpool, or walk whenever possible. They advise people to make every trip count without having to spend much on it. This could include merging numerous stop journeys and buying locally to save money and time in the long term. With prices rising dramatically on everything from food to fuel to vacation, many consumers are resorting to their credit cards to scrape by. While credit cards can be useful in an emergency, failing to pay off the sum in full at the end of your billing cycle can quickly add up. Cards already have famously high interest rates, but as the Federal Reserve continues to hike rates, holding debt will become even more pricey. During a downturn, financial hazards tend to rise. Therefore, it's recommended to avoid taking any new or dangerous investments or loans. It's also a good idea, depending on your position, industry, and expertise, not to take your employment for granted or to draw into your savings unless absolutely necessary. Since many employers are desperate for employees, according to the Bureau of Labor Statistics, the economy had job increases in entertainment and tourism, healthcare, and government jobs near the end of 2022. At the time, the rate of joblessness was 3.7%. But as per many experts, there is still a chance of the occurrence of unemployment. Massive layoffs have recently occurred in the technology and media industries. Even if you don't need the money right now, it could be a good time to take on another job or means of work in the gig economy to supplement your paycheck and assets for the future. Now is the time to brace for the worst while hoping for the best. So, which of these strategies will you be adopting if you find yourself in the middle of an economic crisis? Let us know in the comments below. If you enjoyed watching this video, hit the like and subscribe button, and turn the notification bell on so you can always stay updated with good economic content every time we post. Thanks for watching.